12 days. That's how long it took for SpaceX to make some people rich, make other people sick to their stomach, and erase $600 billion of value like it was never even there. And here's the part nobody's telling you. Both of those things, the riches and the wipeout, happened to the exact same stock, in the exact same 2 weeks, sometimes to the exact same person. My name is Jack, and today we're doing the full autopsy on the biggest IPO in history, 12 days later. Who actually got rich, who got absolutely torched, and the one number buried in the story that tells you exactly what happens next. Stick around because by the end of this, you'll know more about how this thing actually played out than the guy on CNBC with the little earpiece. Picture a guy named Marcus, regular brokerage account, regular job, the kind of guy who watched our video on this IPO a few weeks back and thought, finally, a door that's actually open to me. June 12th, the morning SpaceX starts trading. Marcus gets a small allocation request through, grabs some shares as the stock opens around $150. By the following Tuesday, June 16th, his phone is doing something his phone has never done before. The stock has rocketed to $225 a share. Marcus is up over 40% in 4 trading days. He's already mentally spent the money. He's telling his brother about it at dinner. He feels like a genius. By the following Monday, June 22nd, that same stock is sitting at $154, almost exactly where he bought it. The genius feeling is gone, replaced by something closer to nausea, and the little voice asking the question every single person who's ever ridden a hype wave eventually asks. Did I just lose money on the single most talked about investment of the decade? Marcus is fictional, but I want you to hold on to him because his story is, almost beat for beat, the story of thousands of real retail investors over the last 12 days. And to understand exactly what happened to him, we need to go back to the morning this thing actually opened. So let's set the scene properly. June 12, 2026. SpaceX prices its IPO at $135 a share, locking in a valuation of roughly $1.77 trillion. Just to put that in perspective one more time, that's bigger than the GDP of most countries on this planet, and it's for a rocket company. The offering raises about $75 billion, officially making it the largest IPO in human history, more than double the old record held by Saudi Aramco. But here's the detail that almost nobody outside the trading floor noticed, and it matters more than you'd think. SpaceX didn't do a normal IPO pricing process. Most companies give a price range, take the temperature of investors over a roadshow, and then settle on a number. SpaceX basically said, this is the price, $135. Take it or leave it. And the demand that came back wasn't just strong, it was almost violent. The offering ended up about 3.5 times oversubscribed, pulling in over $250 billion in investor interest for $75 billion worth of stock. So when the stock actually opened for trading on Friday, it didn't open at $135. It opened at $150, an instant 11% pop before a single retail investor outside the initial allocation had even gotten a chance to click buy. And it kept climbing from there. By the afternoon, it touched $168. Trading volume that single day topped 500 million shares, which put it in the same conversation as Facebook's legendary 2012 debut. This is the part of the story that made headlines everywhere, and it's the part that got people like our friend Marcus excited enough to jump in. But here's the thing about an opening this hot. It's not actually the beginning of the story. It's the beginning of the trap. Now, the open was just the appetizer. What happened over the following 4 trading days is the part that turned a successful IPO into a genuine retail trading mania. From that opening price near $150, the stock just kept grinding higher. By June 16th, just 4 trading days after the debut, SpaceX touched an all-time high of $225.64 a share. Sit with that math for a second. If you got in anywhere near the IPO price of $135 and sold at that peak, you were sitting on a gain of around 67% in less than a week. At that price, SpaceX briefly became the 5th most valuable public company on the planet, ahead of names like Microsoft and Amazon. For a few hours, a company that didn't even exist as a public stock 2 weeks earlier was bigger than businesses people have spent their whole careers studying.
And the retail money behind this wasn't a side character in the story, it was the main driver. There's data showing individual investors bought close to $370 million worth of SpaceX stock in just the first 3 trading sessions. To give you a sense of how enormous that is, that's about 4 times what retail investors put into Nvidia over a similar early stretch, and Nvidia is supposed to be the retail obsession of this entire decade. Everyday people on apps like Robinhood and Schwab were piling into this stock with a hunger that genuinely surprised the professionals running the deal. This is the part of the story Wall Street loves to tell because it's clean and it's exciting. New company goes public, stock goes to the moon, regular people get rich alongside the billionaires for once. If the story had stopped right there on June 16th, this would be a very different, much shorter video. But the story didn't stop there. It kept going. It just went in the opposite direction. Real quick, because I get this question constantly. People ask me how I actually track something like this in real time. All the lockup dates, the analyst calls, the dilution news, without spending 6 hours a day glued to a stock ticker. Honestly, the simplest answer is just stick around here. If breaking this stuff down in plain English is useful to you, please subscribe to our channel, Explore USA Money, because we'll be tracking this story the whole way through. Okay, back to the carnage.
So here's where things get genuinely uncomfortable, and where Marcus from our story starts to feel that familiar pit in his stomach. Starting around June 17th, just one day after that all-time high, the stock began sliding, and it didn't slide gently. Within 4 trading sessions, SpaceX had dropped 31% from its $225 peak. Within about a week of the peak, the total drawdown hit 35%, which wiped out more than $600 billion of market value. Let that number sit there for a second. $600 billion gone, on paper, in roughly a week from a single company. So what actually happened? Because nothing about the rockets changed, Starlink didn't stop working, so let's walk through the actual chain of events. Because it's not one single villain, it's a stack of pressures that all landed at once on a stock that honestly had very little room to absorb bad news. The first trigger was almost comically on the nose. On June 17th, SpaceX announced it was acquiring an AI coding company called Cursor in a deal worth roughly $60 billion, paid entirely in stock. Now think about what that actually means mechanically. Every existing shareholder's slice of the pie just got smaller because there are now more total shares representing the same company. That's called dilution, and the market does not love being diluted right after it just paid a premium price to get in. Morningstar, one of the more skeptical research firms on this stock, responded almost immediately by cutting their fair value estimate down to $62 a share, specifically citing that dilution. The second trigger landed right on top of the first. SpaceX revealed it was preparing its first ever investment-grade bond offering, expected to be at least $20 billion, mainly to refinance existing debt and fund all that AI spending. Here's the uncomfortable math underneath that headline. SpaceX posted a net loss of nearly $5 billion in 2025. The combined company, after folding in the AI business, was burning over $12 billion a year just on AI infrastructure alone. So when the market saw expensive stock, plus dilution, plus a multi-billion-dollar borrowing spree on a company that isn't profitable, it did the only thing markets know how to do when they get nervous. It started selling. And then there's the third pressure, the quiet one, that almost never gets a headline of its own, but matters more than people realize. Only about 4 to 5% of SpaceX's total shares are actually available to trade publicly right now. The rest belongs to insiders, employees, and early investors who are still locked up. When that little sliver of available stock is the only thing absorbing both the buying and the selling, prices swing violently in both directions on relatively modest order flow. That thin flow is exactly what let the stock rocket up 60+% in 4 days, and it's the same thin float that let it crater just as fast once the buying paused. It's the same mechanism, just running in reverse. Okay, so now let's get specific, because thousands of people is not a figure of speech here, and not everyone's story ended the same way. Start with the early backers, the ones who got in years before any of this drama. Founders Fund's original 2008 bet, the $20 million check written when SpaceX had failed 3 rocket launches in a row, that position is sitting on paper gains in the tens of billions of dollars. None of the 12-day roller coaster changes that math even slightly.
Alphabet, which has owned a slice of SpaceX since 2015, is sitting on a stake worth somewhere around $100 billion, even after the pullback. These are the people for whom the entire 12-day saga, the spike to 225, the crash back to 154, barely registers as a blip. They were never selling at the peak, and they're not panicking at the bottom, because their entry point was so far below either number that the whole conversation is happening several floors above their heads. Then there's the employees, the thousands of people who hold options and shares accumulated over years of working there for less than they could have made elsewhere. For most of them, the lockup period means they can't actually sell into either the spike or the crash. Their paper wealth genuinely did swing by enormous amounts over these 12 days, but it was never liquid in the first place. The real test for them comes later, in stages, as different lockup windows open over the coming months. And then there's the retail traders who got the timing right, even if some of it was luck. Anyone who requested shares through the retail allocation at 135 or grabbed stock in that first hour near 150 and had the discipline or the luck to sell anywhere close to that $225 peak locked in a genuinely extraordinary short-term gain. That's real. It happened. It's just a much smaller group of people than the headlines made it sound like. Because remember, the actual allocation to retail was thin, oversubscribed more than 3 times over, and a lot of people who wanted to in at the good price simply didn't get filled. Now, the other side of this, because this is the part the hype videos conveniently skip, the people who got hurt here weren't reckless degenerates who bet their rep money on a meme stock. Based on the pattern we've seen across mega IPOs going back decades, they were mostly people who did the most natural, human thing in the world. They got excited at the exact moment everyone else got excited and bought near the top of a 6-day mania because the chart looked unstoppable. Think back to Marcus. He's not unique. There's real chatter from retail trading communities describing the exact same emotional arc. People genuinely venting about losing money buying and selling on the way down, some admitting they got so frustrated they tried to short the stock purely out of spite. That's not an investment strategy. That's an emotional reaction wearing an investment strategy's clothes, and the market does not care how you feel about it. And here's a historical pattern that should make anyone holding this stock right now pay close attention. Researchers who looked at the 15 largest IPOs in the US since 2006 found something sobering. On average, those stocks saw a 50% drawdown at some point during their first year of trading, and finished that first year about a third below their IPO price. If SpaceX were to follow that historical average from its $225 peak, you're talking about a stock that could revisit something in the high 60s at some point in the next year. Now, I want to be careful here. Averages aren't destiny, and SpaceX is not a typical IPO in a dozen different ways. But the pattern exists for a reason, and ignoring it because you love the rockets is exactly the mistake that burns people.
So where does this actually leave us 12 days in? Here's the honest, unglamorous truth. The range of opinion on this stock right now is genuinely enormous. Morningstar's fair value sits around $62. One bullish firm has a target up near $310. The Wall Street consensus lands somewhere in between, hovering not too far from where the stock actually trades today. When professional analysts disagree by a factor of 5 about what a company is worth, that's not a sign you should panic. It's a sign you should be honest with yourself about how much genuine uncertainty is baked into the story. And there are real catalysts still ahead that could swing this thing hard in either direction. Around early July, the stock is expected to get folded into a major Nasdaq index, which on its own could trigger billions of dollars in mechanical buying from funds that have no opinion at all. They're just following the rules of their own index. Stacked right on top of that, the lockup windows start opening through the back half of the year, which means more insiders get the legal green light to sell right as that mechanical buying is happening. 2 enormous opposing forces landing in almost the same window. Anyone telling you with total confidence exactly how that nets out is selling you something. What we actually learned in these 12 days isn't really about rockets or satellites at all. It's the oldest lesson in markets, just delivered at a speed nobody had seen before. A thin float plus enormous hype equals violent moves in both directions, and the people who get hurt are almost never the ones who understood that going in. They're the ones who watched the chart go up for 4 straight days and assumed the only direction left was more up. If this finally made sense of the chaos you've been seeing in the headlines, hit subscribe, because the lockup expirations in that first earnings report are coming, and we'll be breaking down exactly what they mean the moment the numbers land. And next time, we're tackling something just as relevant to your wallet right now: the bond market signal that's correctly predicted nearly every recession since the 1950s, and what it's quietly saying about right now. I'll see you in that one.